Welcome to Dubai Daily, your essential morning briefing on Dubai's real estate market.
This podcast is brought to you by Parag Kundalwal, founder and CEO of Consulta, a Dubai-based real estate consulting and global capital advisory firm. This is episode 33, Cash Flow versus Capital Appreciation Strategies.
Every real estate investor in Dubai faces a fundamental choice, Lily. Do you prioritize immediate rental income, or do you focus on long-term property value growth?
Exactly, Daniel. It boils down to two core strategies. The cash flow strategy is all about maximizing that rental income, targeting properties with high rental yields, say 7 to 10%, often in mid-market areas with strong tenant demand. It provides immediate monthly income.
On the other side of the coin, you have the capital appreciation strategy. This is the long game, focusing on how much a property's value will grow over time. We're talking prime locations, limited supply, and high demand.
The key difference is timing and liquidity. Cash flow provides immediate returns, while capital appreciation typically offers higher total returns, but it definitely requires patience and capital reserves.
So for investors seeking that immediate income, let's dive into the high-yield cash flow approach. Dubai has some incredible opportunities here.
Absolutely. Jumeirah Village Circle is a standout, delivering average yields of 7.82%, with studio units achieving over 9%. Properties there can range from around 687,000 EDA'd for a studio.
And it's not just JVC. You have areas like International City with yields up to 10%, Dubai Silicon Oasis as a growing tech hub, and even Business Bay with its prime connectivity.
The ideal investor for this strategy is someone who needs regular monthly income, perhaps a retiree or someone prioritizing stability. They're typically looking at ready, mid-market apartments or studios under 1.5 million.
And the returns are compelling. Over 5 years, cumulative rental income could be 35 to 50% of the property value. Add in property appreciation of 20 to 30%, and you're looking at total returns of 55 to 80%.
Now, let's switch gears. For investors targeting maximum wealth accumulation, the growth-focused approach is where it's at.
Right. Here we're talking about Dubai's luxury markets. The iconic Palm Jumeirah is a perfect example, with 8 to 10% annual appreciation thanks to its limited supply. Of course, entry points are higher, starting from AED 3 million for apartments.
And it's not just established luxury. Emerging hubs like Dubai Creek Harbour offer massive potential. Think 10 to 15% appreciation, driven by future infrastructure like the new Dubai Creek Tower. Off-plan opportunities there are very attractive.
This strategy is for those with a long investment horizon, maybe 5 to 10 years, and the capital reserves to hold the property. Over 5 years, appreciation could reach 40 to 60%, pushing total returns to between 65 and 95%.
But most sophisticated investors don't just pick one. They use a balanced, hybrid strategy.
That's the smart move. We often recommend a 60-40 split. So, 60% of your portfolio goes into cash flow properties for income stability, and the other 40% into appreciation-focused properties for long-term growth.
It makes perfect sense. The income covers expenses and mortgages, while the other properties build long-term wealth. For a $10 million portfolio, that means putting $6 million into high-yield areas like JVC and Business Bay, and $4 million in places like Palm Jumeirah or Dubai Hills.
So, how does an investor choose which strategy is right for them?
Well, choose the cash flow strategy if you need that monthly income now, are nearing retirement, or want to reinvest rental income into more properties. It's about stability.
And choose the appreciation strategy if you have a long horizon, substantial capital, and are focused on maximum wealth accumulation. You have to be comfortable with lower immediate returns and illiquidity.
And the hybrid strategy is for those who want that perfect balance of income and growth, and who desire portfolio diversification.
Finally, let's touch on market timing. For 2025 to 2026, the mid-market cash flow strategy remains very strong, with yields between 7 to 10%. It's a great time to lock in those high yields.
And for appreciation, the luxury market continues to show strength due to limited supply and high net worth inflows. Growth might be a bit slower than in previous years, but an 8 to 12% annual return is still very attractive.
Ultimately, the choice between cash flow and capital appreciation depends entirely on your financial goals, timeline, and risk tolerance. Cash flow offers immediate yields, while appreciation aims for higher, long-term growth.
And a hybrid approach often provides the best of both worlds. Dubai's unique market allows investors to pursue any of these strategies successfully with the right advice and location selection.
For expert guidance on your real estate investment strategy, you can reach out to Parag Kundalwal at Consulta.
You can find him by searching for Parag Kundalwal on LinkedIn, visiting the website at consultaadxb.com, or emailing parag@consultaadxb.com. You can also call him at +971 58 596 4631. Dubai Daily is here for you every Monday to Friday.